Let's have a look. Hi there, everyone. This is Alan from Fintech Australia. Thank you so much for joining us today. Excited to have some guests today from King Wood Mallesons talking about the challenges currently in market for high growth startups, and more broadly, I think this will apply to a lot of startups who are currently fundraising, but also thinking about moving forward with return to work and workplace health, and obviously the safety regimes that sit around that. Before we begin, just want to quickly acknowledge all the First Nations people during these trying times. I think it's important that we put a few words in today to just acknowledge our support of obviously all the things that are happening globally, and obviously more so being in Australia, our First Nations people. So just wanted to say that before we get started. And as noted, what we're going to be talking about today is a range of issues around capital raising in the current climate. I've probably seen now 3 or 4 different cap raises from founders, and it'll be interesting to hear sort of what people on, I suppose, I don't know if it's the other side of the table, but depending, I suppose, on who you guys are currently working with, to see a different view of the current cap raising climate. So we're joined today by 3 friends from King Wood Mallesons, Anthony, Luke, and Angela, who will be talking a little bit about different areas of cap raising. And then obviously we're going to be talking about, as noted, some of the OH&S and workplace health broadly related issues on getting back to work. So I'm going to hand over to the King Wood Mallesons team, and I think we're going to hear some presentations first, and then maybe we'll take a few questions from the attendees around maybe things that they're seeing in market, or potential challenges, or just broad questions they might have. So I'll hand over to you, and let's get started.
Thanks, Alan. So I'll just start by introducing the team and just running through what we're going to cover today. So my name is Anthony Boogert. I'm a Senior Associate in the Sydney office of King Wood Mallesons, and I'm joined here by Luke Mulcahy, that's also a Senior Associate in the corporate team, and Angela Weber, who's in our employment team. Luke and I are going to talk about some of the challenges facing startups in raising capital in the COVID environment, from both the founder and investor side, and we're also just going to talk about diligence issues that people should be considering, as well as just generally about board formation as well, the difference between corporate boards and advisory boards. Angela's then going to come in and give a high overview of some of the employment law issues that businesses should be thinking about, particularly fintech businesses coming back to work in the COVID environment. As a team, we work with a lot of fintechs. I've worked with founders, investors like Grow and Judo. Luke's helped establish X15 and worked with investors like Sequoia Capital. And Angela's worked with fintechs like 86400 and Iris. So I think with that, we'll put up the first slide. Maybe. So, I mean, this is not meant to be a 101 on financing, but we'll just do a quick refresher so that people will know what we're talking about. You often hear people talking about financing, startup rounds and financing, and I guess we've just depicted it up here on a slide so people can sort of see generally how we think about it, from sort of bootstrapping to seed, Series A and B, and ideally the amount raised and valuation sort of growing over time through each round. It's always important to note that there's a tension every time you raise money between how much you raise, what dilution, as in what sort of percentage of the ownership of the company you're giving up, and the valuation that you get at the time. And particularly in the past, there's obviously been a big push for people to try and get the highest valuation possible. But I think we'd also like to sort of highlight in this presentation today that there's should always be this overlay of what terms are you agreeing to in your financing rounds, because it's not as simple as every investment's the same. there's lots of different features which Luke's going to go into shortly, and different types of investments, and then also different types that might bridge the gap between funding rounds, because agreeing evaluation, agreeing governance rights, these are things that can be quite time consuming, and you may want to just get some funding in the door quite quickly and put off that discussion around valuation until you do a larger equity raise. And so with that, I'll hand over to Luke that's going to run through just a few of the different financing instruments that you might see.
Thanks for that introduction, Anthony. Yeah, on this slide, what we were hoping to do is provide an overview of some of the types of instruments a company may consider when they're looking to raise capital. Some of these will be well understood by this audience, others may be less so well understood. Really the purpose of providing this overview today is just to remind companies and founders that there's a variety of instruments that they can consider using when looking to raise capital in difficult circumstances. As we go through these, we'll point to some of the kind of key features that may be points of negotiation in a raising scenario, or which companies and founders should be cautious of when they're raised. So firstly, ordinary shares. These are very well understood in the market. They reflect an equity ownership in a business with standard dividend and voting rights. They're generally held by founders, management, and family and friends. Usually the holders of these instruments, as well as preference shares and other equity instruments, will enter into a shareholders agreement that governs the rights as between shareholders. But the investors, such as VC funds, will generally look for a class of security with some additional rights, which kind of moves us through to the preference share on your screen. So yes, as we said, generally these will be the instruments that venture capital funds will look to subscribe for when they invest, and each new round of investors will generally want a new class of preference share that reflects any special rights that attach to their investment as opposed to the previous rounds of investors. In terms of an overview of the standard rights that we see attaching to preference shares on the transactions we're involved in, there's usually a board representation right and certain veto rights attaching to the share. And these would generally be rights which the holder holds, which reflects that they might have a comparatively smaller interest in the company, but still give them some control over the management and decision-making process. Generally, the preference shares will have a last in, first out liquidity preference, which would come into effect on a liquidity event, such as an insolvency or an exit. And I think Anthony will just briefly touch on something that you should have in your mind, which is where an investor asks for a liquidation preference of greater than 1. Anthony?
Yeah, thanks, Luke. I mean, this is one point we're going to touch on later and sort of, to be wary of, but, generally, as Luke said, preference shares have this first in, last out with the amount invested. If you find an investor asking for, more than, getting their money back as part of that liquidation preference, we would say to be wary of that. It's probably not a common feature, but one that's trying to protect the downside of the investor by, in a worst case scenario, getting them a return greater than what they've put in. So yeah, thanks for that, Luke.
Thanks, Anthony. Just touching back on some other common rights attached to preference shares. They're generally convertible. What's notable there is it means that the holder of the security has rights to participate in an equity upside, which is particularly relevant where the company does well, and it's in the interests of the preference shareholder to participate in some sort of liquidity event as an ordinary shareholder as opposed to as a preference shareholder. Preference shares will generally have some sort of dividend rights if dividends are paid at all, although normally profits would just be reinvested in the business in the startup phase. Where the preference share does have a dividend right, that is usually paid in priority to the holder of lower ranking preference shares and ordinary shareholders, and there'll generally be a dividend stopper in the terms. One thing that companies and founders should be aware of again here is where there are cumulative dividend rights that attach to the shares. And again, Anthony might just jump in here and provide some thoughts.
Yeah, again, I mean, we generally think that dividends aren't paid in high growth companies, all the profits are being invested back into the business. I mean, often if you do see it might be if dividends are paid on the ordinary shares, they're also on the preference. So I would be very wary as a founder raising capital if people are asking for cumulative dividends, because that's effectively saying that if there's not a dividend of a certain amount paid because the company does have profits, that gets added to the amount invested and effectively builds up the equity in the investor over time, and doesn't really reflect risk sharing between the investor and the business.
Thanks, Anthony. And maybe here, just to touch on one of the last features of these preference securities is the anti-dilution protections. Do you just want to talk us through how those provisions would work in a kind of full ratchet, partial ratchet, and maybe just touch on the weighted average ratchet?
Sure. So I think often people talk about anti-dilution protection, but we just put this slide together so people could see it visually, because we think it's quite helpful in terms of the tension between founders, investors, and how anti-dilution works, particularly if you're coming up in a situation where you might think you might have to raise capital at a lower valuation, or you're under pressure. Thinking about how the anti-dilution protection works is important. The example on the screen is for a full ratchet, which shows that effectively the conversion price for the Series B investors converts at the is maintained, or the earlier, so the Series A and Series B is actually maintained even if there's a later investor at a lower valuation. As you can see from the diagram, what actually happens is the new investors come in and effectively all the equity is taken away from the founders. There's obviously extreme example for a full ratchet, but it does draw out how investor friendly the full ratchet is. It effectively just automatically adjusts down that conversion price without any reference to how much is raised in that round. So even if it's a very small amount, the adjustment of the preference share into equity is already it's gone down to the more favourable conversion price. What we would normally see, and what's more typical, is a weighted average adjustment, which looks at how much is raised by the financing and how that affects the existing investors. So it's not such a disproportionate adjustment. There's always debate as to what goes into the calculation of the weighted average. Is it just shares issued? Is it vested options? Is it vested and unvested options? And each of those calculations will be slightly founder friendly or investor friendly, depending on how wide or narrow the weighted average is. The wider it is, the more founder friendly it is; the narrower it is, the more investor friendly it is.
Great, thanks, Anthony. Maybe now moving to a safe investment structure, which is something that we think might be particularly attractive to both companies and founders in the current environment. They're becoming much more common in Australia. It's effectively a similar structure to a convertible note, but simpler to document because there's really no interest rate or maturity date features that are introduced. The safe will convert to equity on the occurrence of a subsequent funding round or exit event. Conversion to equity generally happens at a discount to the price of securities in the funding round or the exit event, and it's just a commercial feature to reflect that the safe investor invested at an earlier stage. Another common feature of a safe is a valuation cap. By this we mean a notional maximum valuation of the company, and this provides upside protection for the safe investors as it results in the amount invested by the safe investor converting to equity at a maximum price, which may be lower than the price at which the subsequent funding round occurs. Sometimes safes will have a debt characteristic, which effectively means that it's a debt owed to the investor up until the point in time the instrument converts to equity. This isn't a common feature of the safe, but it does provide an investor with some downside protection as they be a higher ranking creditor in an insolvency scenario. The other things to keep in mind if you're looking at a safe is, unless there's a shareholders agreement in place, you'll need to set out some governance terms and high level guess, principles that will be incorporated to the shareholders agreement when the SAFE converts to equity. Reasons why SAFEs are popular and should be considered at the moment is the flexibility and speed that they can provide in an investment scenario. Legally, they involve much lighter documentation, and commercially can help bridge gaps between different parties' thoughts on valuation. Where they're not a debt instrument, safes don't carry interest repayment requirements or have a repayment date that can kind of act as a gun to the head of the company. They only ever convert to equity on a funding round or an exit. The one thing that founders should be mindful of is the dilution that does occur to their interest when the instrument converts. Just moving to the last two bubbles on this slide, it's the kind of more dead end of the spectrum, convertible notes, which are fairly well understood. They, similarly to SAFEs, allow investment to get done more quickly, although often there's additional complexity incorporated into the note, which means that they can lose some of the simplicity. Other pros of a kind of convertible note structure is they generally don't require evaluation and can also be used as a bridge to future equity raisings, which in the current market could be a good way to get through the short-term impacts to capital markets that have been caused by COVID-19. In terms of the cons of this instrument, they remain a debt until the conversion occurs. And as I mentioned, complexity can be introduced into the terms, which mean that we lose a lot of the kind of quickness to execute that would otherwise be available. And I guess finally, just to touch on what we've called here venture debt, but that's effectively just debt type funding. Pros is that they obviously don't dilute the interests of founders, and the shareholders again can be used as a bridge between equity financing rounds. They generally don't require collateral in the VC space, but the lenders will obviously expect a return when it comes through their investment, which probably at this stage is worthwhile mentioning a warrant, which is something that a venture debt lender may require if they're going to provide debt. Anthony, do you want to talk to that briefly?
Yeah, so just warrants are another thing, effectively just free options that go along with a debt financing. You know, again, just something to be thinking of. If people are asking for warrants, it normally means that they're thinking that the return on the debt is not sufficient. So the interest rate they're getting on the debt and the risk there is not sufficient for the risk, and so they're looking for additional equity upside. If the business performs well. Again, if you're raising money, it's reflecting, and you're thinking that you just want to raise debt, and suddenly warrants are on the table. I would put that as sort of a warning sign that maybe the investors' view of the business isn't the same as your own.
Great, thanks, Anthony. Maybe we should move to the next slide, which is a slide we put together, which tries to draw out some of the things that the investors will be thinking about in the current environment. So I guess one thing we noted on in relation to both the convertible notes and preference shares we just spoke about is that they provide usually some downside protection for investors. So it's something that we think that investors will be looking at in the current environment. Similarly with safes, they provide downside protection, especially when there's a debt element involved. Generally though, where a debt feature is included in the safe, there's probably going to be a trade-off in terms of the discount that would be given to the investor on a conversion on a liquidity or exit event. Another thing that investors may be considering at the moment is whether they will accept pay-to-play provisions. Now, they're not a usual provision that we've seen in the market, but if they are introduced now, we expect them to be something that would be kind of hotly negotiated. Generally, pay-to-play provisions are something that are inserted in a fundraising document, which are designed to provide a strong incentive for investors to follow their investment in future funding rounds. The provisions can be varied, but generally they involve a conversion of the instrument that an investor holds into another instrument which has different, effectively lesser rights if the investor doesn't participate in the future round. investors that we've acted for strongly resist these pay-to-play provisions, as it really requires them to provide continued financial support in circumstances where they may not want to do that. Although from the company's perspective, it does allow them to say to investors, well, are you really supportive of our business and are you really here for the long term? Where pay-to-play provisions are included in investment agreement, there are some kind of mitigating features that investors will generally have the benefit of, and they are the fact that they'll have board representation in the usual course. So those directors will have input on the decision whether to complete a subsequent funding rounds. And they'll also generally be given timeframes to make decisions whether to invest. So if it's just a liquidity issue for the investor, there's usually a period between 30 and 60 days for them to follow their investment in subsequent rounds. Anthony, do you want to talk any further to the anti-dilution bullet here?
No, I think let's just get on to the next slide.
Yeah.
So maybe, yeah, just bring it all up. So look, I guess every time startups are raising money, there's always, depending on the time, it might be a founder-friendly environment to raise money, which we definitely saw a couple of years ago. I think in the current market, it's probably going to swing towards more of an investor-friendly market where there's going to be more founders chasing less money. And so there's probably going to be more investor-friendly terms coming up. I suspect things like pay-to-play that Luke just mentioned are not going to be there, and something that was more a feature of really founder-friendly fundraising. So we've just highlighted here, just a few, and we've already touched on some of these earlier, just a few of the points that we think founders should be wary of. If they see these come up in term sheets. The key things being that you're probably dealing with investors that have, do this much more regularly than you if you're a founder, and they may be saying one thing about their belief in the business and they're wanting to share in the upside and not being concerned about the downside. But if you start seeing some of these features, it may be suggesting that their view of your business isn't the same. And I guess back to my sort of first point on every fundraising has this tension between valuation, terms, amount raised. It's important to think that even if you're talking to someone that's giving you the best valuation, if it comes with a lot of hairs on it because of some of these additional terms, maybe it's not worth it. So just to sort of canter through these, if an investor's asking for secured financing, I would be questioning that. At the end of the day, security is designed to provide a financier with the ability to control insolvency. I think that if you're a fast-growing company, you don't want your investors being concerned with insolvency. That could even suggest that they have some what's known as a loan-to-own strategy, which means lending you money in a bid to ultimately acquiring you. If you see participating preferred shares, this is something that existed a long time ago in VC that sort of had gone out of favour, which effectively allows the investor to double dip, which is to get their invested capital back and then share in the upside. We would normally say that it's non-participating preferred is the standard convertible share instrument used these days, and it really allows the investor to choose between getting their amount invested back or converting into ordinaries and going to being on the same as founders. Greater than one-time liquidation preference we touched on before. We also touched on warrants and cumulative dividends, so I won't speak about that. So redemption rights, you often see this as VCs asking for a right to basically have their investment paid back at some time in the future. There's definitely a few different views on this. Some will say, well, if the business is doing well, you should be able to raise capital in the future, so don't worry about it. I think from a founder perspective, we would always say, having an obligation to actually raise, to raise money to pay out an investor at a future time, will put a gun to the head of the business. So you may not know how easy it is at that time to raise money, and that could force you to take some decisions that you're not comfortable with. And then lastly, special approval rights. So you often see in shareholders agreements investors getting certain vetoes. It's always important to be conscious that these vetoes should really go to things that are fundamental to protecting the value of the investment and don't go to overriding strategy and other things that allow the business to grow. So whenever negotiating approval rights, I'm always conscious of what are the business's plans, what flexibility do the founders and management need to really make the business succeed. If you have a very long list of approval rights or very particular ones that are going to hamper your ability to execute your strategy, those terms could actually be quite negative to the company. And we did touch on warrants before. Luke, do you want to talk about some of the features that, if you are going to accept warrants, that you should be thinking about?
Yeah, sure. I think we would just suggest limiting the number of shares that the warrant entitles the subscriber to subscribe for, which effectively goes without saying. Negotiate the exercise price. From the company's perspective, exercise price should always be the fair market value of the security that it converts into at the time of exercise. From the investor's perspective, exercise price would be market value at the time of the warrant being issued. Like all things, it's probably a number in between those two endpoints. Expiration date, company would want their warrants expiring as soon as possible. Investors favour long term. As Anthony mentioned earlier, it's effectively a free option. We suspect in the current environment, the time period should at least be enough to get through, from here, maybe the next 3 to 6 months to get a better understanding of how Corona has impacted the relevant business. And as a fourth limb here, really just limit the circumstances you agree to issue warrants where you're sweetening a current investment. I guess we'd advise our clients to steer away from using them as a way of attracting new investors in. Anthony, should I flick to the forming a board?
Yeah, so let's just cover this. So we thought it would be helpful just to sort of draw out the distinction between a board of directors and an advisory board, just because often the term board gets thrown around a lot. People are forming businesses, they're bringing together key people to help guide them, but it's important to be clear as what the differences are. So board of directors is the governing body that's legally responsible for running the business, and each of the directors have legal duties, most importantly to act in the best interests of the company. Normally you'll see material investors want to be have a seat on the board that allows them to be present when key decisions are being made, so they know what's going on. And then, as I mentioned earlier, they may have veto rights under as a board member under their governance arrangements. Separately, it's often quite common for businesses to set up an advisory board. So an advisory board has no legal standing. It's normally just a collection of advisors that come from very different backgrounds, strategy, customers, technical expertise, sales expertise. And the whole idea is that they're senior people in the industry that are brought in to really guide the business and help it succeed. Again, it's important to think about the distinction here, because the actual legal board of directors ultimately controls the company. If generally as a founder of a business, you'll want to maintain control of the board until you get to a successful exit. But board members will often bring expertise. So I think our recommendation here is to really strike the right balance. You probably want to have a small formal board of directors that has representation from your key shareholders, but as a founder you still have a majority ownership there, and then try and have a broader advisory board with the connections that you have sitting on it, and having people that really know the industry and can add value, but aren't necessarily being caught up in the formalities of your actual board of directors. If you are going to get some advisory members also on your board, think carefully about the number of them and who's involved. So I might hand back to Luke just to cover up our last point before we go to Angela on due diligence issues to be considering in the context of COVID-19.
Yeah, thanks, Anthony. And this is really just a bit of a transition to Angela's part of the presentation. I guess in addition to focusing on the commercial terms of investment, we've seen that due diligence processes have become more complicated in the current environment. It's meant that there's been increased time frames to due to the physical challenges of inspecting premises and even just populating data rooms. It limits the ability to conduct due diligence in person, conduct site visits, as I mentioned, and even just meet management teams in person. So effectively what we've seen is that the period that people are asking for effectively due diligence exclusivity between signing a term sheet and completing an investment is likely pushed out. On this slide are kind of just headline areas investors have been focusing on in due diligence in the current environment. And it's probably worth then just handing over to Angela, who will talk about some things that we should be thinking about from an employment and WHS perspective.
Thank you, Luke. Thank you, Anthony. Has that come up okay?
It has on my screen, Angela.
Yes.
Perfect. Okay. So I think it hardly needs to be said that COVID has presented fundamental challenges to the way that we work and the way we employ people. And so I'm going to talk through a couple of really key employment issues that have businesses faced in living through the COVID-19 pandemic. So I'm going to start with workplace change. The pandemic has transformed the economy and changed how many of us work, particularly those people on today's webinar. And many companies are keen to know, what changes can I make in my workplace to help my company survive through this pandemic, essentially. And the Fin Review, you may have noticed, is littered with articles about big organisations cutting employee salaries, going to 4-day week, sending their employees on forced leave or shutting down altogether. But none of this can be done without understanding the legal framework. Otherwise, you may find yourself in court. So we're going to touch on the key things to know about implementing workplace changes. The first thing to think about is the employment agreement. Like any contract, it is binding on both parties, and both parties are expected to comply with its terms. And that means practically that you cannot change things that are covered in the employment agreement unilaterally. You need to do so with employee consent. And they may or may not be willing to give that consent depending on the employee, their individual circumstances, and how reasonable they may feel that change is, and how necessary it is for the survival of the business. The next thing to think about is the actual overlay of the Fair Work Act. Now, even if you obtain agreement to do something with obtain agreement of the employee, you cannot contract out of the minimum entitlements of the Fair Work Act. So you cannot agree that the employee is going to receive something like Uber Eats instead of receiving a salary. That's not going to be permitted, even if the employee thinks it's a wonderful idea. So you need to be aware of whether or not the change is actually permitted by the Fair Work Act. And the next thing to think about as well is industrial instruments. So enterprise agreements, which I suspect would be very rare among fintechs, but probably more likely modern awards. So the key one that would apply to employees in this sector is the Banking, Finance and Insurance Industry Award. I'm hoping that at least some people here today are nodding their heads, and not everybody is hearing that term for the first time. But many things about the way in which people work in the finance industry is covered by that award. And so it will be really important to make sure that any changes you're seeking to introduce are permitted by that award. And also the award contains an obligation to consult with employees if you're thinking of making major changes in the workplace. And so if you are contemplating change, it's important to know, do I have to consult with my employees about that? And to have a plan for consulting before you go ahead. Otherwise, again, you do have exposure to legal risk. There have been some temporary changes to certain modern awards to give more flexibility to employers through this COVID-19 error, but not to date to the Banking and Finance Award. So in summary, if you're thinking of making changes, the questions to ask are these. Do I need employee consent? Is the change permitted by the Fair Work Act or any modern award or other industrial instrument that applies to my employees? And do I need to consult before I go ahead? And those three things will hopefully assist you in implementing change that is legal. So I just want to turn it and deal relatively briefly with the very well publicised JobKeeper scheme. So I'm not going to talk about eligibility either from an employer or employee perspective. I'm going to focus on the directions that can be made if you are participating in that scheme. So the scheme doesn't just involve wage support, the fortnightly $1,500 payment. It also introduces temporary changes to the Fair Work Act, which enable employers greater flexibility to ask employees to work differently in this period and to do so lawfully. And these things are known as JobKeeper enabling directions. We won't go through all the different permutations of these types of directions, but to give you some examples, one category of direction is stand down directions. So an employee can be asked not to work on their normal days, to work shorter hours, to work different hours. Otherwise, there is no general right to stand employees down in this circumstance. So the JobKeeper direction in that sense is stepping in to fill the gap of this completely unique situation we all find ourselves in. There are also provisions to allow a company to direct employees to take leave. That request can be made and the employee cannot unreasonably refuse, and that can be a very useful tool for dealing with a downturn in demand caused by COVID-19 and allow the business to sort of wear down some of that cost that is carried with leave balances. You can also obtain employee agreement to work on different days and at different times and to direct employees to do different work, subject to various conditions, including notice requirements and at in some cases, consultation requirements as well. Those types of directions are only applicable to employers and employees who are actually participating in the scheme. So it's unique to the JobKeeper scheme, and these types of directions will cease when the scheme itself ceases. So at the moment, the sunset date for the scheme is the 27th of September. So unless it's extended by the federal government, anything that is implemented by employers pursuant to the scheme will fall away after that date. Turning then to other strategies for reducing labour costs, particularly if you're not participating in JobKeeper and so the options pursuant to that scheme aren't available to you. The obvious thing that many businesses have been forced to do is to implement redundancies. Now, it is very often a rather complex area of law to navigate implementing redundancies. So it's really important to understand the lay of the land before you embark on a process of downsizing. Otherwise, there are various claims an employee can make, and those claims may well be more costly than simply keeping the employee on. So it's a really prudent measure to seek advice, seek out information, and make sure that you've got a plan to implement redundancies in a way that is going to achieve legal compliance. So the first thing, obviously, is that if you're implementing redundancies, the role needs to be genuinely redundant. So that sometimes can be difficult to ascertain, but it's usually fairly clear in cases of such significant economic downturn when there is noticeable reduced economic activity that typically results in reduced revenue for businesses and therefore reduced ability to keep employees on. So it's the role that must be redundant, not the employee, and there must be no intention to continue to have those duties performed, although it is permitted to reallocate those duties to other employees. So you can have them absorbed elsewhere. But essentially, you cannot have that collection of duties in that role continue. Otherwise, the redundancy would not be genuine. So you also really need to understand the legal process, as I said, to avoid exposing the organisation to legal liability. And the key thing to appreciate here, particularly in relation to award-covered employees, are the obligations to consult and to consider redeployment. And they're things that really should be thought of upfront in the planning phase of implementing redundancies. So you've thought about them, you've put in place a plan to comply with those obligations, and you're in control of the process. And as we've said on the slide, most employees will be entitled to severance pay, provided they've got over 12 months service. And that entitlement is typically found in the Fair Work Act, although sometimes employment contracts can also set out a separate entitlement. Now, I'll just very briefly mention the stand down provisions of the Fair Work Act. Now, the Fair Work Act provides a default power to stand down employees without pay where they cannot be usefully employed, but it has to be due to a stoppage of work outside of the control of the employer. It's important to appreciate that typically a recession or the broader economic downturn brought about by COVID-19 wouldn't cut it to invoke those provisions. You're really talking about situations in which some external factor has effectively shut down your business. A relatively clear-cut example is what's happened to Qantas's workforce. So state governments have effectively shut down domestic travel, and so the workforce cannot possibly be usefully employed. So Qantas has had a fairly clear-cut right to stand its workforce down. But the application of that type of provision, particularly to fintech companies, is probably unlikely to apply, but you know, it will obviously depend on the circumstances. And the other things then to think about in terms of reducing labour costs and potentially avoiding redundancies are the types of things that we've already talked about in terms of reduced hours, again, typically by consent, directed leave periods, so asking employees to take annual leave or long service leave, again, subject to overriding award terms, and also salary reduction, and that obviously must be by consent. Turning then to working from home, many fintech members will already have very well entrenched remote working practices. And I think the COVID-19 pandemic has shown that for organisations that have invested in that capability, they have really reaped the rewards of that, because their workforces have been able to seamlessly transition to working from home. But it is important to understand that the work health and safety laws continue to apply to employees working from home. Essentially, the home becomes the workplace. And so as a business, you do continue to have duties to ensure the health and safety of your workers, regardless of where they're working. And that means, in practice, a couple of important things. You need to assess the workplace, that is the home office environment, for risks to health and safety, and you need to take all reasonably practicable steps to eliminate those. What that actually requires in practice is relatively well established. It's about providing your workforce with guidance on what a safe office home office setup is, including what a good workstation setup looks like. If your business can afford to provide employees with equipment, then that's a really fantastic measure that can be taken. But if not, can they borrow equipment from the office to kind of help them have a better setup at home? Making sure your employees know the basics of ergonomics and how they can undertake a self-assessment at home and check their own setup. And then finally, the mental health side of things. So keeping in contact with your employees. Aside from COVID-19, mental health is a hugely costly workplace issue, and people are under significant stress at the moment, and coupled with the isolation of working remotely, perhaps homeschooling their children, and whatever pressures may be coming from the workplace, people's mental health is definitely under pressure. So it's an incredibly important risk to be aware of and to take steps to manage. Finally, to the extent that you already have developed policies about work health and safety, incident reporting, that type of thing, you do need to think about how those policies should be adapted for working from home, because you still need a method for employees to communicate with you about risks and say, look, this is unsafe, or whatever the case might be, so that you can be aware of the risk and take appropriate steps to manage it. Now, some of your employees may well be working from home for an extended period of time. Maybe you're thinking about permanently working from home, but most companies are thinking about a gradual return to the workplace in some way, shape or form. And there are a couple of things I want to highlight regarding returning to the office environment. Again, the work health and safety duties are paramount here. As a company, you have a duty to take all reasonably practicable steps to eliminate the risk of COVID-19. And that's a rather weighty responsibility that companies will face into as employees return to the workplace. So that's the duty of the company, and the directors themselves have their own duties, their own personal duties of due diligence, depending on the jurisdiction, to be personally satisfied that the company is doing everything it should be. So there is a real incentive for directors to seek information about that and obtain appropriate levels of assurance and comfort that the company is doing what it should be doing. Now, Safe Work Australia, which is the sort of federated body of the state and territory regulators, has published an absolute wealth of guidance about the safety considerations of COVID-19 and returning to the workplace. So without wishing to direct you away from the services of your workplace lawyer, that really is the best possible resource for knowing what are the regulators' expectations of me as a business when I allow my people to come back to the workplace. What is a risk assessment? What do I need to know about? How is it going to affect? How does social distancing affect my workplace? What about the kitchen, corporate sport, the office lift, whatever the case might be? Enormous amount of material has been published, including specific to office workers, that really is your go-to resource for understanding the expectations of the regulators. The other thing is that the response to COVID-19, whilst it's been coordinated at a federal level, it is mostly a question of state and territory governments and their response. So you need to make sure that you are aware of and staying on top of the directions in each state and territory. For example, Victoria has just implemented a new directive that essentially people should work from home at least for the rest of June unless they're unable to. So there is not uniformity across each state and territory. And first and foremost, you need to make sure that you're following the directives in the state and territory in which you're operating. Now, once you return to the office, what will that look like? Do you have to test your workers? Do you have to take their temperature on the way in each morning? These are all questions that people are really dealing with at the moment. I think the first thing to say is that putting aside the things we just talked about returning to the office and the preventative measures in place, it's really important to have a plan to deal with a suspected or diagnosed case of COVID-19. Again, Safe Work Australia has some very helpful resources for that. So it's not just about preventing, it's also what are you going to do if someone turns up to work and says, I actually think I might have come in contact with somebody, or I'm feeling unwell, whatever the case might be. Now, the National COVID-19 Coordination Commission has developed a COVID safe plan. Again, a really good resource. It's not exclusively WHS related, but it provides a really good starting point for businesses to think about getting back to normal, not just in relation to their employees, but in relation to their operations more generally. There may be some benefits in undertaking sort of screening of employees, but the evidence is really still out in relation to that. At the moment, Safe Work Guidance does not recommend conducting temperature checks. It's not considered to be a particularly useful method of screening people for the potential risk of COVID-19. I think in Sydney recently, one of the private schools here had been temperature screening students every day, and yet still had a student attend school who was COVID-19 infected. So it may indeed give people a false sense of security, and it's not currently recommended by the regulators. In relation to conducting tests for COVID-19, what I would say about that would be that you really need to obtain advice at that point in time. If you do intend to ask employees or an employee to take a test, there are privacy considerations to be aware of, and typically you cannot force an employee to take a test. So, however, you can, request that they provide, for example, evidence that they are no longer infected by COVID-19 or whatever the case might be. But it can be a difficult area, and it's always good to seek advice if that does come up. Now, I'm sure many of you have opinions on the COVID Safe app, and it's another useful tool for mitigating the risk of COVID-19 in the workplace. If you're thinking of requiring employees to sign up to it, think again, because you definitely cannot do that. The legislation is very clear that an employee cannot be told that they must download or use the app. They certainly can be encouraged though. And I think as part of the toolkit for managing the risk, it is one thing that is something to think about. As to whether we will return to normal, that's obviously a very big question, and there's all sorts of predictions about the end of hot desking, and companies indicating that they have a portion of the workforce who want to permanently work from home. So it remains to be seen whether the office of the future will look anything like it did pre-COVID. But I think what we can say from a work health and safety point of view is that until we have a vaccine, until the risk is more or less eliminated, workplaces are very likely to be much, much emptier and sparser, because fundamentally, the more people, the more risk of transmission. So that brings to an end the content I wanted to cover from an employment point of view. I might hand back to Alan to facilitate any Q&A from the attendees.
Thanks for that, Angela. Thanks, Luke and Anthony, for those insights. I think they were really interesting. Definitely on the capital raising side, it's an interesting time. I mean, I think you raised some really interesting points around definitely the terms that potentially could sneak into deals that are currently in market. I'll start with a question before I maybe read a few of the questions, or one question at least that's popped up. But just a reminder to everyone that's attending, feel free to drop the questions into the chat, and I'll add these to the questions I'll ask the team. So I sort of break out, when I speak to founders, I break out a fundraise in terms of the structure of fundraising to sort of the economics and the provisions, right? And I think if we think about the economics are usually very clear. The valuation, the amount that's being taken in the round by a particular investor. On the term side, what are you tending to see as being, and maybe we'll start with veto rights, because I think those ones tend to catch founders out or tend to surprise founders the most. What do you think on the veto side is most common? What's common practice? And maybe I'll start with, for example, boards. I think you sort of spoke about the right to have a board member in when equity is taken. What kind of other terms do you tend to see that are common versus ones that potentially are not as common, just to give founders a sense of some things they can expect? And again, we can talk about whether it's on the preferred share side, or whether it's safes or convertible notes. What are some of the more common things? I'll throw to Luke or Anthony on that one.
Yeah, I'll take that, Alan. I think on the common side, you'd see terms that really relate to the particular instrument the investors invested in. So you can't change the terms of that instrument or other investments while they're there, particularly other restrictions on raising capital that's senior to that investment, so they know that they sit there. Where it sort of strays into things that are less common might be directing an exit, so saying you might not, you can't do an exit until this time or with a minimum valuation, or even getting really granular, like there must be the annual business plan must be approved each year, and expenditure. So I think as soon as it gets, when you're thinking to, are you restricting raising capital that might be senior to the investor, that's things that I think is common. But when it's more business operational decisions, hiring employees, I think that's ones where you would think, that's probably outside what the investor should typically be getting, and one that's really likely to restrict the business going forward.
Cool. Yeah, I think that's a good bifurcation, right? Which is that there are things which impede or sort of impact on the rights of the note holder or shareholder versus the operational stuff, which I think you're right. Like, I tend to sometimes see small things like that creeping in, like the business plan or sort of veto rights around things that potentially the management team can or can't do. And I think that's a really good way to sort of break it out. So we've got a question here from Belinda. Do you see in capital raising the issue of senior unsecured notes, not subordinated or convertible to shares, just pay interest on debt and a term and repaid at the end of term? So it's a bit of a mouthful.
Yeah, look, I think we do. I know there was, a venture debt fund that was raised last year, and it's pretty common in the US. Silicon Valley Bank just has straight, debt that they invest. The key thing is that because the return on debt is generally lower, some sort of interest rate, it's, you generally won't see, venture debt being provided to really early stage businesses, particularly if they, they don't have cash flow that looks like it's going to come in to pay the interest. It's more, you would generally see it as more of a mature business. It's already got sales coming in, it's got some profits that they're expecting to pay back the interest, and confident they'll either be able to pay back the principal or refinance at the end of the term. So I think you see it, but it's more common for more developed businesses, ones that are getting closer to exit IPO than really early stage rounds.
Yeah, great. If anyone has any more questions, feel free to drop them in. Maybe I'll ask a question to you, Angela. What do you think are some of the challenges that companies are going to face, definitely at the smaller end? Like, I think, just to break it out, most of our members of Fintech Australia are sort of in that smaller range. What are some of the challenges you think that some of our smaller members might face returning to a work environment, the office space?
I think it's going to be how to ensure that the return to work is safe. Whether you've got your own office environment, or perhaps it's being co-shared with other companies, as lots of small organisations do, there's going to need to be a lot of communication with the landlord, with the co-tenants, and with your employees about the risks of COVID-19. And it's a shared responsibility. Employers can't do it alone. You need to ensure that your employees are sort of on board with the measures that you put in place, and are sort of being responsible in terms of their own hygiene and social distancing in their spare time. And then as well, ensuring that there are no risks posed by, your co-tenants if you're sharing premises or the floor even. So I think that's likely to be a significant practical risk for small businesses who are using office environments. To the extent that members are going to continue working from home, I think there's a real challenge with keeping employees motivated and engaged. It's a lot harder, I think, to do that remotely, and you miss that sort of socialisation and chit chat in the kitchen that sort of builds relationships. So I think that's a sort of another challenge as well.
Yeah. It's definitely, I think, going to be a challenge for people, not only to revert back, but you're right, sort of to keep those motivation levels high during sort of an uncertain time. Okay, so just looking to see if we've got any more questions. I might ask one more in relation to what you're seeing on the capital raise side, Anthony and Luke. Are you seeing practically terms coming in which are a little more, let's say, onerous than what we've probably seen in the last, call it last 12 months, where markets have been a little bit warmer? Are you practically seeing any changes in the way investors are acting?
Yeah, look, I think we are. We're seeing terms that are coming in that they are, a bit more onerous. There seems like investors are conscious that they're in demand more. They're not chasing as many deals as maybe 2 years ago, and founders are more chasing them, and so they're the terms that they're serving up are seeming to be more investor friendly, and that's why I guess prompted us to have this discussion, because we thought there's some terms that seem reasonable and maybe just a sensible rebalancing of terms between founders and investors, and some that probably go a bit far and could really be I guess founders should be wary of.
Yeah, cool. We might leave it there, but any parting comments, anything you guys want to add, just in terms of what founders should be wary of? This sort of one tip. I think there was really great information presented today, but maybe if we leave everyone with one tip or thought before we go, I think that might be a good way to summarize, and maybe just leave on an actionable point.
Sure. Thanks, Alan, for giving us the opportunity to present today. Really appreciate it. I think the one tip, at least on the fundraising side, is that getting the maximum valuation isn't the be all and end all, and that you may be that you get an offer at a slightly lower valuation, but it's much more founder friendly terms that'll really help you, grow the business and succeed. So don't be focused purely on the valuation.
Great, no worries. Thanks a lot, and again, thank you for the time today. And at this point, I usually ask people to put their hands together, but I'm sure virtually everyone will put their hands together for today's presentations. And thank you again. Thank you again to all the attendees for coming along today. Appreciate you engaging with the community and being involved. As always, if you have any questions for Fintech Australia, please feel free to reach out to Rebecca or myself. And then more broadly, I'm sure we can put you in contact with the team at KWM if you have any